What's up, everybody? What's going on? Bosscase FX family. I hope you guys are all doing good. And welcome back to our YouTube channel, guys. And in today's video, I'm going to give you a step-by-step guide on how to use supply and demand and find high probability setups to trade from. So if you are also new here, don't forget to hit that subscribe bell and turn on the notification icon so that you will not miss out any new concept from this channel. So guys, what you have to do when you're doing your simple forex analysis on your daily basis of trading, right? You have to look for your swing structures, which will give you your internal structure, and the internal structure will give you a new swing point, right? So as you can see here, guys, we have Euro USD, and this is our H4 time frame, right? And you can see that we did have this swing low, and then this swing low have created a swing high. So anything between a swing low and a swing high will now become our internal structure. As you can see, we have an internal structure from this point until to this swing high right there. So this will now become our trading range right there. So whenever you have identified your swing low and your swing high, right, you have to understand that a swing low will take out the previous swing high, right, creating a new swing point. So as you can see here, we did have this swing high right here. As you can see that the price went to the downside, they came back and created a new lower high, and then the price went down, taking out this previous low, creating a new lower low, meaning now we have a new swing low right there. And then the price managed to go up and take out this swing high right there, and then they started going up until they reached a point of interest, which is our supply zone area. So as you can see on our left side here, we did have this swing low right there, and you can see that the price took out this previous high right there, meaning we did have a previous swing high, and then the price created a new swing high, meaning now this low will now become a valid swing valid swing low. And you can see that a job of a swing high is to create a new swing a new swing low right there. We do have this new swing low right here, meaning this one will also become a valid swing point, right? You can also see that we did have a trading range. So a trading range is whereby you find this internal structure from a swing high to the swing low, and then you have to look for a point which will now create a new swing structure in the market, right? So as you can see, we did have a nice break of structure at this momentum right here. Let me just put it so that you understand, right? So let's put it on center, right? As you can see, we can see that we did have a nice break of structure right there, and you can see that we also did have this opposite candlestick, which will now become our supply zone, but this one was being tested before. So whenever price is now coming back, this point will now become our inducement zone area, right? Something like this. And then we'll have to look for another point of interest, which will now give us a supply zone area. So this zone will now become our supply zone area, and this zone will now become our new swing high, because you can see that it managed to push the market to go to the downside. So a job of a swing high is to create a new swing low than the previous low right there. As you can see, the price failed to come and create a new swing low than this previous swing low, but they have created a new swing low above a previous low. So this means that the price came back to this failed high right there, which will now become our flippy supply to be a demand, right? So this zone will now become a demand. But before I explain here, let me give you a bit of explanation on how these demands and supply works. So guys, whenever price is going to the upside, right, remember we have what we call a swing high, which is this one, right? So this swing high, its job is to create a new swing lower than the previous low. As you can see, let's say this is our previous low, and then the price will come, but they will not break this swing low, but they will create a new swing low above this swing low. This means that the price is now creating a scenarios of weak highs and strong lows. So whenever price is now going to the upside, right, they will be creating a new swing point than the previous swing point, and then they'll come and create a new swing low right above the previous low, and then they'll start going to the upside. So this means that this failed supply zone area now, it will now give us a flippy demand. So that's where you will find out sometimes price will not come back to the actual order block, but the price will come to a zone which we call a breaker block. So a breaker block level is more powerful than the order block because the price will create a swing point at the breaker block level, right? So sometimes they'll just use a inducement. Once they come back, that's when this zone will now become a inducement. So they'll come and take out this zone, coming back to the to the order block, which will be down here, and then the price will start going to the upside. That's what you have to understand. And then it will come back to a scenario of whereby if we are using a chalk, right, if we are using a chalk, let's say the price have reached the demand zone A, right, something like this. Sometimes you find out that you highlight this low right here, and then you find out that the price will not come back, but they will respect a breaker block. As I said, whenever price is going to the upside, right, this breaker block level is where the price will create a new swing point, right? So if they come back again, so this swing low will now be used as the liquidity zone area. So let's go back to chart and let me give you some of the examples. So as you can see now, the price came back to this failed supply and then flipped to be a demand, right? But the price didn't manage to come back to this swing low, right, to create a new swing low. So they created a scenario of a new swing low above this swing low. This means that this low is a strong low, right? This low is a strong low. So this high will now become a weak high. So it's possible for price to continue going up until they take out this high, and then you anticipate a move to this previous extreme point, which is your supply zone area. So this zone will now become our liquidity point, so the price will come and take it out, right? So this one will now become our liquidity, or what we call a inducement, right? Something like this. So what you have to do, right, you have to understand what I said. Whenever price create a swing a swing low, they will create a new swing a new swing high, and then anything between a swing low and a swing high will now become our internal structure. So what you also have to understand, right, price may come back to this supply zone area to retest and then rebounds going to the downside, right? But you have to have what we call a confirmation. So this could be your supply zone, which price just came back to mitigate, because if you go back to your daily time frame, right, you can see that we did have this opposite candlestick right there, meaning we did have a break of structure at the top, and at the bottom we did have a change of character, and then the price respected what we call a fair value gap or a imbalance, and then they shifted the market going to the upside. Now you can see that the price is at the supply zone area. So what you have to understand, right, you want to see if price will give you what we call a change of character, which we showed you here, guys, as you can see. So here is the pattern which you are going to be using for your confirmation entry point, and I'm gonna show you some of the example how to use it. So as you can see, this was our swing low and this was our swing high, and then we did have this failed swing high here, which is our supply zone, and now it being flipped to be a demand. So this is the first turning point which you have to understand, right, which price have created or being taken out, right? And now you can see that the price came back and then respected it. It was never being tested before, so they respected this zone area. And now you can see that we also have this this confirmation which we use. We have a break of structure at the bottom, a break of structure, something like this. Let me just put it at the bottom, and you can also see that we did have a change of character right there. This was going to be our change of character, and now you can see that the price have created a bullish engulfing candlestick, meaning this is a big big order block or a big demand zone area. So what you are going to do, you're going to refine it to be your your fair value gap. As you can see here, guys, you can see that the price did try to go away to the upside, right, and then they failed to continue going away to the upside, meaning they respected a supply. So this zone will now become our supply zone area, and then they shifted the market. So this supply was being taken out, meaning we do have a failed supply at this momentum, which will now give us a flippy demand area, right? So if we go back in 15 minutes time frame, right, let me just zoom in so that you can see nicely. So as we go back in our 15 minutes time frame, you can see that okay, the price respected our supply zone area at this momentum right there. You can see we did have a supply, right, we did have a supply zone area, and then the price came back going to the to the demand zone area, right? So after price respected a demand zone area, the price have created what we call a fair value gap or a imbalance level, right? So you can see that clearly we did have this demand zone area right here, but what you have to understand is that here we do have what we call a fair value gap. So they will come and fill the candlestick right there. So they will do something like this. You have to highlight the last high or the last low here, and then the last high here of this candlestick, and then this zone will now give you what we call a fair value gap or a breaker block level, right? So the price will come and respect that zone and shift the market going to the upside. So if you now go back in 8-4 time frame, let me just bring the chart. As you can see, it will now give you what we call a breaker block level. As I said, there's a failed supply zone area, so it have to give us a flippy demand. So you can see that the price managed to push the market going to the upside, and as well they did give us a break of structure. So you can see clearly that we did have a break of structure at this momentum right here, right? So this was a clean break of structure. So the next thing which you expect price to come back to the demand, and you can see clearly that we did have this demand level right there, right? Something like this, right? As you can see, this will now become our demand level. So if you see this demand level, something like this, you have to refine and use 15 minutes time frame. So in 15 minutes time frame, you are going to be looking for a base area. As I said, sometimes price will not come back to the extreme order block. They can respect a breaker block. You can see in this scenario, price didn't come back to the to the order block, but they came back to the what breaker block level, right? And then now you can see here clearly that the price did come back to the what to the order block or the demand zone area, and then they shifted the market going where to the upside, and you can see that the price just came back to this zone area which we call our base area, right? You can see clearly we did have a drop, and then this will now became a base and then a rally. You expect price to come to the demand, and then they'll shift the market going where to the upside, which will now become your continuation pattern, right? And you can see clearly that if we go back to H4 time frame, we did have a nice demand level, and then the price managed to come back and pick the orders and shifted the market, meaning now you are trading from this swing this swing low right here, guys. This swing low right here, we have a swing low right here, we also have a swing high right here. So anything between a swing high and a swing low, it will now become our internal structure, as I said. So this was the first best drop which was being created by the price while the price was going to the downside, meaning we did have a break of structure. You can see that clearly the price didn't come back. So this zone can also be a liquidity point whereby the price just came back to induce this zone and then coming back to a supply zone area. But what you have to do, you have to have a confirmation, right? But before that, you can see that the price have now given us a new breakout structure. Let me just delete this so that our chart will now become clean. So you can see, okay, we have a new break of structure right here, right? So for you to trade from this break of structure, you have to look for a breaker block. You can see that clearly, as I said, you can see that we did have this supply zone area. So you were expecting price to turn from this supply and then shift the market going to the downside, but the price didn't do that. The price continued going to the upside. So this supply have to be a flippy to be a demand. That's why the price came back and then shifted the market going to the upside. So for you to understand all of this, you have to understand these points. Now you can see here we did have a failed supply and we did have a breaker block, and then the price picked the orders, shifted the market, come back to the demand, shifted the market again. So here we also have a breaker block. So if you go in 15 minutes time frame, you're going to do the same thing over and over, right? You're going to do the same thing over and over. You can see, okay, we do have this failed supply zone area, right? This is a failed supply, right? So the next thing, you have to look for a flippy demand. So this zone will now become your flippy demand area right there, a flippy demand area. You can see price clearly came back and shifted the market. So for you to highlight the fair value gap nicely, you're going to do something like this. You can see in this scenario we did have a last opposite candlestick. So this one was going to be our demand, right? So this was going to be an inducement. You can see clearly this zone was being induced, right? You can see price induced this zone, and then they shifted the market going to the to the demand, and now they finally went in to the last demand area which you were expecting. So if you use the last high as your take profit, this was going to be your take profit right there if you see a new break of structure. So the price just came back and hit your take profit now, but they are in the supply zone A. But for you to confirm that the price is now going to the downside, you want to see a change of character. As I said, you have to look for a change of character. So you can see clearly, okay, we do have this demand. So now what you'll be expecting, you want to see if price will hold orders from this demand right here and shift the market going to the upside. And then if they finally take out this weak high, right, you now understand that the price is coming back to this supply zone area, and then you go with the price while the price is creating these scenarios. Now guys, let me just go and show you. So whenever price is going up, right, you just have to look for this failed supply, and then you look for a breaker block. And also if they do not respect a breaker block, you just look for a demand, and then the price will continue going away to the upside. But to have a good confirmation, you are going to use this change of character pattern. So I hope this video will help you. You just have to do your back test, and also please don't forget to hit the subscribe bell for the new next content. Have a blessed day guys. Thank you for watching.